Welcome to the Meb Faber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
This episode is sponsored by our friends at YCharts. Not too long ago, I highlighted YCharts' release of their 2024 election guide. It was packed with all the data and visuals you need to tackle those commonly asked client questions as election season heats up. But with President Biden dropping out of the race, YCharts wasted no time in updating the guide to help ease your client concerns and keep them informed when it matters the most. Let's do a little trivia. Out of the last 12 presidents, how many saw the S&P 500 decline during their presidency? The guide answers that question and provides historical performance and volatility around election times in a way that's easy to share with clients. Grab your copy with the link in the show notes to unlock exclusive access to downloadable charts and visuals that will elevate your client communication and boost your client's confidence in you as their advisor. And don't forget, get 20% off your initial YCharts professional subscription when you start your free YCharts trial and tell them that I sent you for new customers only. Go to the website, go.ycharts.com/meb-faber. Welcome back, everybody. It's summertime. We have an awesome show today. Our guest is Michael Mauboussin. Michael is the head of Consilient Research at Counterpoint Global, a $70 billion equity manager. He published some of the best investment research out there. I'm excited to have him on the show, talk about markets, concentration, things like shareholder yield. Michael, welcome to the show.
Meb, awesome to be with you.
There's no better compliment to give someone in 2024, and you can probably tell your kids this, than you've been turned into a meme. And there's no better tweet that I love to see than when someone writes, "Hey babe, wake up, a new Mauboussin piece just dropped," and a link to one of your new research pieces. And invariably, they're like 20 pages, 50 pages long. So I clear my day, and I just heard news. You just told me, exciting news, that by the time the show comes out, you'll very likely have a new piece out. So I got to put it on the calendar already for my wife. Got to tell her, clear schedule. Give us a hint. Give us a preview. What are you working on?
Well, we always got a lot of things going on, but one of the topics I've been really fascinated, we can probably go off in different directions as we talk about this in more detail, is fundamentally about capital allocation and equity issuance and retirement. Let me first say that one of the most powerful signals we have in markets, and I'm telling you something you already know, is companies issuing and retiring equity. And it's not really a symmetrical signal. When companies issue equity, it tends to be worse for subsequent total shareholder returns. And when they buy it back, on average, it tends to be a somewhat positive thing. But basically, that's a really powerful signal. The second issue is capital allocation. Right? So if you're an executive company, the idea is to buy low and sell high. And that means if your stock is undervalued, you buy it. If it's overvalued, you issue it. And so what we are interested in is taking a look at the sweep of companies. Obviously, lots of issue stock for compensation. That's fine. Lots of companies buy back stock. Typically speaking, smaller companies are the ones that issue equity. That makes a lot of sense, right? They're getting going. They preserve cash. It's all good. And typically older companies, more cash rich, more profitable, they buy back stock. But there's this interesting group of companies sort of in the middle that both simultaneously issue a ton of equity, mostly for stock-based comp, and also buy back a lot of stock. So the question we're asking is, if the stock is mispriced, and management probably has a better look at that than investors since they have better information, one side of that trade's got to be suboptimal, right? Now, I'm not sure in the big wash of total shareholder returns, it makes that big a difference, right? I'm not sure. There are a lot of other factors that determine total shareholder returns, but it's just sort of this interesting intellectual thing. And I don't know if it's really cognitive dissonance. I think managers do think about both of these things, but not necessarily in the exact same breath. They do think about buybacks in the context of stock-based comp, but less stock-based comp in the context of buyback. So that's just sort of an interesting topic just to throw out there. It's just an interesting corporate finance topic, interesting capital allocation topic.
It feels like if I put myself in the mind of one of these executives, on the one hand, they're like, hey, we really want to reward employees, although I imagine most of this is going to the C-suite. I'll default to you on this. But in their head, they're like, we also don't want to dilute shareholders. So we're just going to buy this back to mop up this stock-based compensation. Do you think that's kind of what they're thinking?
I think different companies have different philosophies on this, and it's actually empirically been determined because John Graham and others have done surveys of CFOs and executives, and they ask them this direct question. And almost always the answer, yeah, we buy it back because we think it's undervalued, it's a good signal to the markets and so forth. But they very, very quickly will tack on, like, we want to offset dilution from stock-based compensation, we want to enhance our earnings per share, and if that could be a possible case. Right, you're also raising another issue, which is what is the power of stock-based compensation? And to the degree to which it aligns the interests of shareholders and executives, that's great, right? Obviously, as a mechanism to retain employees that you want to retain, that can be very valuable. But, one of the questions is whether what happens is if your stock goes down, do companies just to let their employees suffer along with the shareholders, or do they issue more equity to sort of fill the gap? Is it a pay delivery system, or is it really incentive compensation? And 2022 is really an instructive thing. The stock market went down high teens, 18 or 19%. Stock-based compensation for the Russell 3000 companies went up 19%. So it wasn't like the employees were not taken care of. They just bumped up the comp in order to sort of backfill what they lost in foregone, basically stock-based comp. So then that becomes the issue. We're all on board if management gets a lot of equity and they deliver a lot of returns and they do really well. We're all on board with that. The issue becomes if they're middling, are they using this a way to deliver pay versus to incentivize?
We talk a lot about this on the podcast, and no one talks about it more than really you or Buffett. I think Cliff really drills into buybacks and all the misinformation surrounding the topic, which, and Professor Damodaran does as well, but kind of all the misinformation around buybacks. But to me, the big part of this cycle has been this share issuance topic. So a lot of particularly tech companies out in my home state issuing a ton of share issuance. Brad Gerstner, we'll throw these in the show note links, talks about some of these companies that are just massive amounts of stock-based compensation. I think Snapchat would certainly be one that fits the bill. When you look at this cycle, so the past 50 years, buybacks have been ascendant, of course, and everyone I think kind of gets that or starting to get it. The share issuance part, I feel like, is a more recent entering the discussion, because I think we usually, when we do screens, it's like the average stock roughly, I think, is that in the stock market, it's a share issuer. And you have all these companies that are issuing shares, but that tends to be something that people ignore. How do you think about this whole discussion of time varying buybacks as something that influences returns?
In this century, so since the year 2000, so let's call it almost 25 years, by our numbers, aggregate equity issuance, and equity issuance would not just be stock-based compensation. Actually, the biggest piece of that would be stock issued for M&A. But stock issued for M&A, seasoned equity offerings, which are offerings that are not related to IPOs, and then stock-based comp, which is the second biggest piece. That's been around a little under 10 trillion. Share buybacks, also last 25 years or so, have been about 14 trillion. So retirement exceeded issuance by about $4 trillion in the last quarter century, roughly speaking. Now, a couple of things I'll just mention. Buybacks, as you point out correctly, in the United States sort of ascended starting in 1982. People have to understand their history. Sometimes people talk about saying buybacks were, in quotes, illegal before 1982. That's completely wrong. Buybacks have been around for a very long time. In fact, there was a series of really fascinating papers about buybacks in the 1960s. Charlie Ellis, by the way, one of the incredible luminaries in our industry, wrote a book about share buybacks in the early 1970s. But people don't seem to realize that they were around, and not only they were around, they were topics of books. The reason they were a little bit of the Wild West was new companies ran the risk of being charged with stock manipulation. And in fact, a lot of the discussion back in those days is, what percent of the volume is the company and so forth. And by the way, the SEC did bring cases against certain companies for stock price manipulation. So in 1982, what happened specifically was the SEC set up a safe harbor provision that said, hey, companies, if you follow these rules, we're going to give you a safe harbor. You're not going to be charged with stock price manipulation. That is what opened the floodgates for companies to start doing buybacks in the early 1980s. I think you're an advocate of this. By the way, this is really important for people, investors, to think about this. Comparing dividend yields today to dividend yields in the 1950s or 60s is completely nonsensical. You should actually be using some sort of shareholder yield, which is net buybacks plus dividends divided by market capitalization. Much stronger signal, much more sensible, and a much more stable signal, by the way, as well. And there have been people advocating for dividends, in quotes, making a comeback. If buybacks get taxed further, maybe at some point there's a tipping point, but I just don't see any real reason. I think the flexibility that executives feel with buybacks is pretty substantial. And in fact, if they're doing it right, and they have asymmetric information where they can buy low and sell high, but buy low for sure. If you're an ongoing shareholder, it's great. If the company really is buying stock for the right reason and you do nothing, you increase your percentage ownership in an undervalued asset. That's all good.
I know you're a big fan of Charles Darwin. So I actually pulled up about a half dozen Charles Darwin quotes that we're going to interlace through this podcast as jumping off points. I had one to start the show, but I got all excited about your new paper, so I got distracted. But there's some good ones. And then the one that I consistently think about is narrative and storytelling in our world. It's such a huge, huge force in thinking about dividend investing. So there's a Darwin quote where he said, "Often a cold shudder has run through me, and I've asked myself whether I may have not devoted myself to a fantasy." And so thinking about an idea that you look back on and say, oh, I should probably change my mind about this, or like I shouldn't adhere. But the problem in our world is where you have giant asset managers that are managing trillions that have been promoting a certain concept. It's a lot harder to change your mind.
On some level, especially if we get very theoretical, we can demonstrate the buybacks and dividends are effectively equivalent, right? You have to make assumptions about taxes and timing and all other stuff. But basically, it's a mechanism to return capital. And we all, if a company's buying back stock, you have the option to create a homemade dividend by selling your proportionate share and getting your cash and so forth, right? Okay, so that's all fine. The reality is that investors and executives think of them as totally different. So notwithstanding that theoretical equivalence. So for example, and this is maybe why there's a signaling thing, when executives issue a dividend and they want to raise it over time, and they think of it as tantamount to their CapEx and R&D, and like sort of this is our priority way of spending. Then if they do all the investments they want and their balance sheet looks pretty good and there's some cash left over, then they go, oh, let's buy back stock, right? So it's almost like a residual thought. And I think that permeates a little bit of this whole discussion. The second thing is really interesting is our industry is replete with discussions about total shareholder returns. And just to state the obvious, total shareholder returns assume that you take your dividend and reinvest it back in the stock with no friction. So you could do that in a tax-free account, but the reality is, and this has been studied, very few institutions and very few individuals actually do this. So the idea of total shareholder return is essentially a fantasy that basically nobody earns. By the way, mutual funds, they get a dividend check, they just goes into cash and they do whatever they're going to do with it. Individuals typically consume their dividends. They don't reinvest it. So that's another thing we just have to be mindful of is how do people think about, in quotes, when dividends come in, they're not reinvesting it in order to generate total shareholder returns. They're typically doing something different with it. So that's another thing just to mention. It's a very interesting literature on this. And it's almost like people don't recognize it. Oh, a dividend means, stock's at $100 and I get a $2 dividend. It means the day after it pays, I have a $98 stock and $2 in my pocket, right? They forget the fact that the price goes down by $2 to compensate for that dividend payout. So it's funny how you talk about storytelling, but people just don't think about that way at all. And you could see how that would be relevant for, mom and pop, and maybe if they're clipping dividends for whatever. But, institutions do the same thing, which is really interesting.
I think it's the mindset where people sort of confuse or they collate check in the mail. The dividend story is so ingrained, sitting on a beach, drinking pina coladas, and letting my dividend checks roll in. Like that sounds like an amazing fantasy to people, right? It's like you're getting paid to do nothing. And so that's interesting on the part of the consumption because the price-based return is quite a bit different than the dividends reinvested. And by the way, I got a quiz for you. So listeners, you got to take this quiz too. I know you're a fan of Hank Bessembinder, and we had him on the show not too long ago. And I had him, someone had asked a question. I said, I know Hank's got the answer to this. So assuming you haven't seen my tweet, maybe you have, but listeners, we gave away 10 hats if you got this answer right. I said, Hank, what's the best performing stock in history in terms of total percentage return over lifetime? And so this is Chris' database, which starts in 1925. So he sent us a list of the top 100. And let's see if you can get numero uno. Do you have any guesses here?
I'm not going to get it. I would guess the top wealth creators, but I think that's a different thing than what you're saying, right?
It is different, but it's probably similar. So it's just basically the total percentage return.
The ones that would immediately come to mind would be multiple choice, would be Apple, Microsoft, but it's going to be probably some rando thing that you're going to say that.
Neither of those are in the top 20. And the reason being is because they haven't been around that long. So the ability to have compounded since 1920 essentially swamps the ability to compound high. The astonishing part of this was only, I think, 6 or 8 of the stocks in the top 100 had compound returns over 20%. Number one was Altria, so Philip Morris, but 16% a year, but $1,000 turned into over $2.5 billion. Asterix, you had to reinvest the dividends.
Exactly.
265 million % return. So, but number 2 and 3, like I couldn't even name them. Number 2 is Vulcan Materials, but it goes to show more the time compounding rather than the number. We could be talking about overconfidence now and probability. This actually leads into another Darwin quote. He says, "As for a future life, every man must judge for himself between conflicting, vague probabilities." Talking about vague probabilities, talking about markets, the big topic du jour is concentration, which you had an amazing paper on recently. Maybe tell us a little bit about that paper, and I'll pepper you with some questions as we go along. Where do we stand today? I think since you wrote it, things even got more nutty.
Yeah, a few points on that. First of all, as with all these types of topics, I'm always very reticent to wade into these things. So as you point out, a lot of people have written well about this. But I thought that there were some interesting aspects of it that had not been reflected. So we jumped into it. So the first point was taking a look at concentration, going back perhaps a little bit further than most people have. Now, we had good data back to 1950. We have data going back even further, but I wasn't quite as confident in that data. We found basically is that concentration as of year-end 2023, and we'll come back to your point that it is higher now, was 27%. And that was a level we had only seen most recently back in early 1960, so called 60 years ago. I think the reason it's been on people's radar is that concentration at 27%, this is a top 10 stocks as a percent of total market cap. That number was 13 or 14% 10 years ago. So it's been not only we were at recent highs, but sharp increase in the last decade. And I think that's what has been disorienting for people. Now, if you go back further, you go back to 1930s, it averaged something in the 30s, so like this is not unusual. Today, I don't know the exact number as we speak now, but it's in the low 30s, 31, 32%, top 10 stocks. So that's the first thing, just to give a little bit of history on this to understand where we are in this sweep. It's not that unusual. We also went around the world. This may or may not be a fair thing to do, but we said, let's just look at the top dozen markets by equity capitalization. And, the U.S. is actually among the most diversified. In other words, the lowest concentration. Now, that's not really that fair because U.S. is 60% of the global market cap. So as the U.S. goes, so goes the world. And then a couple other aspects we added to this that I thought were interesting. One was, okay, if I gave you, Meb, a clean sheet of paper and you knew nothing, and I said, figure out what you think market concentration should look like in a proper world, how would you do that? So you might come up with different ways and techniques. One of the things we argued for is taking a look at economic profit and saying, okay, there's a distribution of economic profit. Maybe the concentration should reflect whatever the distribution of economic profit looks like. So what was interesting when you examine those numbers as of year-end 2023, again, the top 10 companies were 27% of market cap. They're about 69% of the aggregate economic profit. And economic profit's important because it's return on capital less cost of capital spread. So it's how much you're earning above your economic rents times your invested capital. So the first piece is value creation. The second piece is how much money you can put to work. And if you go back over the last decade, that number has been the economic profit percentage consistently higher than the market concentration. So that's another interesting one. The next thing we wanted to look at was, hey, what happens if you own the big guys, right? What if you own the number one stock or the number two stock or the number three stock? And by the way, I've last read about this probably a dozen years ago. There's a paper by Rob Arnott, Research Affiliates, and Rob was saying it's horrible to own the number one guy. You really get trashed. And so we created an index. And the way the index works is we started in 49 actually, at $100. And you owned the number one stock for that year. And then whatever that TSR was that went in. And then if the number one stock changed, we flipped it, right? So you always own the number one stock for that year from 1950 on. The number one stock, so it starts at 100, this index. That index ended in 2023 at 4, like down 96%. And by the way, what is incredible is that actually represents a huge rally off the low. It was actually at 1.5 or something like that. So the Rob Armanot thing was exactly right, which was it was for 65 years at least, it was really bad to own the number one stock. Number two, number three did okay. They sort of meander around, but they end up, the indexes are over 100. And by the way, I should say those indexes are excess returns and they're just total returns. So they're excess returns. But what stood out and what jumped off the page and what was distinct from what I'd read from Rob was in the last decade, those top stocks, top three stocks were phenomenal. And again, it's the suspects, it's Apple and Google and Microsoft and so forth. And so we had 65 years of history that taught us one lesson, and the last decade that taught us a totally different lesson. And then the last thing I'll say was it's just sort of an interesting mathematical thing is that if you're an active manager, so this is now I'm going to say a fundamental active manager, on average, the market capitalizations of the stocks they own are smaller than those in the S&P 500. So we examined, for example, we went to Morningstar Direct, that we looked at 500 US domiciled funds that use the S&P 500 as their prospectus benchmark. In 2023, 400 of them had market caps much lower than the S&P 500. The other 100 about even or bigger. And those 400 just got left in the dust, right? Because when large cap is doing well, basically exposed to small cap, and you get left in the dust in terms of performance. By the way, the other 100 that were as big as the S&P did great. So they were fine. And so the basic trend is when large cap outperforms small cap, active management tends to struggle. When small cap outperforms large cap, which by the way was true in the 1970s, it was true, by the way, in the first decade of the 2000s, active management actually does relatively well in terms of the percentage of funds that beat their benchmarks. So when you talk about all the hand-wringing, one of them is the fact that the sharp ascent in concentration. But what that means by definition is that it's been large cap ripping, and large caps beat small cap in 9 of the last 10 years. And that becomes a very difficult environment for active management. So I think all those things were the things you sort of mix up into the bowl and stir. And that's why all this stuff is bubbling up. So a couple of those points, I think, people had alluded to them, but I think were not fully fleshed out. And that's a little bit of what we try to go after.
You hit the nail on the head on what makes our entire world so challenging, which is you can have a investment philosophy perhaps backed by ideas and research and sound economic theory, all these type of ideas. And then lo and behold, you can have it be wrong, not for like a week or a quarter, but essentially for an entire career. Post GFCs, we're going on 15 years now, ignoring the little small cap jiggles we've seen recently, but things like market cap, highly concentrated, underperforming, was seen as on average, one of those vague probabilities we talked about earlier. How do you think about, over the course of your career, ideas that you hold sort of, I don't want to say is true, but is just things you believe, but that can be wrong for a hell of a long time? That's an entire career for a lot of people. And if you've been betting on some of these, you may not be gainfully employed anymore. How should we think about some of these challenges?
Really hard to state the obvious. And one of the things that I always like to appeal to, you mentioned teaching. I teach at Columbia Business School, part of the Halberd Center for Graham and Dodd Investing, right? So this is sort of Ben Graham's original home. What does value investing mean these days? And, value investing has always been, I think should always have been, buying something for less than what it's worth. The way I would translate that in more modern terms is figuring out like what expectations you're pricing into a stock. And what you want to do is buy low expectations and sell high expectations. Multiples or shareholder yield or other measures might give us an indication like which pond we should be fishing in, but the multiples or the yields are not the answer, right? They're steps in the right direction. So part of it is just to be really as flexible as possible, say where are the opportunities and where are expectations mispriced. And, I think the most difficult thing is if you're more of a value-oriented person, stepping out and saying maybe the growth is going to be faster than what we'd anticipated or what we've seen in the past. And Meb, I'll just say that related to that, you told me there was going to be a group of companies that would be this big, that would grow as fast as they've grown, as profitably as they've grown. I think I would have not believed you, like literally not believed you. So for the folks who had the insights to sort of anticipate that those things actually could unfold, I mean, it's been great. So the answer to all this is there are hard and fast rules. There are immutable things, right? Buy something for less than it's worth. The value is present value, future cash flows, all those kinds of things. If we meet in 50 years, we'll still be saying those same things, I believe. But there's a whole lot of stuff that's mutable. And that's like, how is the economy changing? What is the nature of investment? What does that mean for its ability to grow? What are the profiles of returns on capital look like? As you mentioned, even roughly in my career, the watershed changed from dividends to buybacks. There are funny stories. You probably know this, but in 1957 was the first year that the yields on stocks dropped below the yields on high quality bonds. And market veterans were like, this is the end of the world, right? I mean, I think it did revert briefly, but basically that whole rule of thumb got thrown out the window for basically the rest of time. And so you have to just keep that open mind as far as say what's going on out there. But it's to state the obvious, it's super, super difficult. And like you said, even in the last few weeks, we've sort of seen almost, I don't know, violent might be a big word, but like, pretty strong shifts in how the markets behaved as a consequence of certain inflation figures and economic data and so on. And I always like to joke when I write about something, typically is the point at which it's sort of maxed out. So I didn't quite like this concentration. I don't know if it's perfectly maxed out. I'm really trying to observe and not predict. And that's a very big distinction here. So I just want to say, here's sort of like what's going on versus what's going to happen. I don't know what's going to happen, but it is interesting just to collect facts and see what's actually happened already.
I love looking at, we'll put a bunch of these charts in the show notes, listeners. And hopefully if you're watching this on video, some of these charts will be interlaced, but there's one where you have like the shifting stocks with the largest market cap in the US over the past 70 years. And it's fun to see the names change. It's not always Apple and the various leaders of today. Back in the day, it was GM and DuPont. And it's even more fun to look at that globally too. But here's the crazy part. You almost have to have the humor of a comedian in our world and going back to those vague probabilities to say, look, here's what I think is probably going to happen. But like, there's a scenario where like this happens. And we used to always talk about this with valuations and CAPE ratios. And there's no real reason this couldn't go to 50 or 100 PE. So you got to be prepared for those possibilities because they can last a long time.
Areas that I've been very consumed by in the last 3 or 4 years is work on intangibles and intangible investment. And you go back to first principles, what do companies do? They take resources and they invest them. It could be money, it could be people, whatever it is. And then they hope that those investments will yield a product or a service that people would want to buy, and then they can make money doing it, right? So the building block of an investment is as simple as it can be. Again, this is very much happened in my investment career, is we've shifted from tangible to intangible investments. And the fundamentals of what investments mean that hasn't changed one iota, right? But what has changed is how it's reflected in financial statements and so on and so forth, right? So if you're following cash, you're fine. That's not an issue. But if you're relying too much on accounting numbers, I think there have been major distortions that have been introduced. There was a really nice paper by a guy named Anup Srivastava, University of Calgary. He's an accounting professor. And he looked, I mean, this is going to a little bit high on the nerd factor, but you're going to get the point of this. He went back and looked at companies in various cohorts. These are the decade in which they went public. So the 60s, 70s, 80s, 90s, and so forth. And then he said, how well does cost of goods sold, or the cost you're assuming to produce revenues, and accounting, obviously the matching principle board, how well they match? And the answer is they match great, and they match for all the different companies, all different cohorts. Fine. Cost of goods sold, we're all good. Then he said, how well does SG&A match, right? So again, the matching principle is really important in economics and finance and accounting. And he found that the matching was really good for the companies in the 60s and 70s, and then just completely degraded from then on to the point where he basically said, like, there's almost no matching for SG&A and revenues today. So what does that mean? The answer is what we're getting in traditional accounting numbers are not the same thing that we used to get generation or two before. And so again, it is what it is, but you have to be aware of that. And you have to go back to first principles thinking and say, do I understand the investment? Do I understand the return on investment? Do I understand the cash flows versus saying, I'm going to default to a PE multiple or even a CAPE ratio or something else, because those may not be as insightful as when they were developed because they reflected a different time.
You had a really fun piece, Attributes of Great Investors in 2016, which you were looking back on some of the things that you believe that are important as you're thinking about investing, having been through this period where the S&P just steamrolls everything and every single investor really almost in the world. Does that piece still hold up? Anything you feel different about it?
I think it probably does. By the way, I wrote that literally on the 30th anniversary of my investment career. So you can figure out exactly how long I've been doing this. And I think that those attributes were sufficiently generic that it would be hard to say, because it's like be open-minded and read a lot and think probabilistically and understand accounting. And so I think most of that stuff is going to be mom and apple pie. Maybe what I would just keep emphasizing, what I've learned a lot about. One is I just mentioned like the shortcomings of accounting. I think that everybody understands that accounting is the language of business. I think that we tend to default to headlines like simple things like earnings without really understanding the value and creation implications. I think this intangible thing is a big deal. This notion of thinking about the world probabilistically, Bob Rubin, by the way, has got these great quotes about this. He's written a lot about this, but his argument is like, you explain the thinking about the world probabilistic to people and everybody nods their head vigorously. They all go, yeah, totally get it. But the question is, how many people in reality actually do that? And the answer is not that many, right? So that, again, it's a little bit like a diet. It's not that hard to understand, but it's very difficult to actually do day in, day out. And so that's another aspect. And so I've learned a lot about the kinds of tools and techniques that allow people to think probabilistically and enrich the way they think about the distributions of potential outcomes. I should have written about this when I wrote that report, but I want to be clear to the listeners too, that there are a lot of different ways to invest. Renaissance technologies, what those guys do. Okay. So what I'm writing about is a very specific way of like sort of fundamental investing. And so it's not going to be a one size fits all. There are qualities that are going to be good for everybody. So constantly learning and thinking probably that's going to be true everywhere you go. But just to be clear, that I don't want to come across as saying like, this is the, in quotes, the one way to do it. There are lots of different ways to do it. By the way, I'll say, Meb, that piece was kind of funny because I put it together at the last moment. I didn't do much research. I just sort of like was winging it a little bit. And it was actually one of the most popular things I've ever done, which is interesting. And the other fun thing about that is we did do a 30-year retrospective. So we look, where does the world look like at the time, 2016, as you point out, and what did the world look like in 1986? And it's pretty fun just to take a step back and just sort of see how different the world is. I mean, it's hard to think about a world without the internet. It's hard to think about a world without cell phones and how much the cost of technologies come down. PCs were relatively novel. I mean, people had them, but they were not kind of fully commonplace. It's interesting how different the world was. When I started as an analyst, if I wanted 10Q for a company, I would have to request it from the library. They would get it and they'd mimeograph it and they'd send it in interoffice mail. That's how I would get a 10Q. So just think about that was in my career, right? So just think about how much has changed. It's pretty fun to contemplate.
You have a good list of books in that article too. So we'll put it in the show notes, listeners. It's fun to reflect. Speaking of the probabilistic thinking, I had a tweet the other day where I was talking about the roaring 20s and valuations and talking about how the 1920s started at a long-term P ratio of like 6 and how you had multiple expansion and amazing decade. But I wrote an article back in 2017 where I was talking about as like people have some this is 2017. Markets have been great since then, but the long-term kind of CAPE ratio is 29. And I said, look, investors have high expectations. This bull market's been running wrong. And so they don't expect 10%, they expect higher. And I said, for this to happen, what's the most likely scenario is not that, but rather that multiples maybe stay where they are or come down. But to meet expectations, multiples need to go up. Now, that's happened before. I just said it's probably unlikely. And so looking back on this piece, someone said, good for you for calling yourself out. I was like, well, hold on. Like, that's the whole point of probabilistic thinking is you're saying there's a chance this happens. And even if there's a 10% chance, that means it happens 10 times out of 100. I'm not trying to not admit I was wrong, but it's more just that like things can happen that's the way that works.
I mean, this is going to sound a little goofy, but in the fall of 2023, we wrote a piece called Total Shareholder Returns. It's just as simple as can be. And I was actually drawn into this topic thinking about value traps, right? So this idea of a stock that starts at statistically cheap, as you mentioned, sort of perhaps a below market PE multiple and so forth, and why it just continues to slog along. Then I was like, well, let's just go back to the basics of what drives total shareholder returns. And it basically is exactly what you said. It's basically to say some sort of price appreciation, which can be a function of earnings times some sort of multiple. And then you're going to have a dividend reinvestment piece. Okay, fine. But it's interesting when you break it down, there are two things I'll just point out that I think are really interesting. Talking about earnings per share and earnings per share growth, right? To get to net income, it's operating income. And we've really seen a lot of margin improvement over time, but sales numbers don't change all that much. Sales growth rates all that much. But note in the last 40 years, we've really benefited from two things in a very material way. One is lower financing costs. That may have turned around, say, 2022, but certainly that long-term trajectory was down, and it's still below certainly the 40-year average. And the other is tax rates, right, which has also gone down. And there's some rumblings that may change no matter what happens in the administration change, but that's an interesting one. So there was a very strong positive differential between operating profit growth and net income growth, which going forward may not be quite as favorable. The second thing is really interesting, going back to our conversation about buybacks. We were talking about the motivation of buybacks. Well, one of them is that when you have very low financing costs, whether it's interest on cash that you're earning or financing costs, you can buy back stock, and even at a pretty high multiple of earnings, it's accretive to earnings. So it adds to earnings per share. And so you can do the math. And by the way, people sometimes say that buybacks are always additive to earnings per share. That's absolutely not true. And the reason it's not true is because you have to pay for a buyback. And if you pay for it, it's usually cash or borrowing, and that's going to have an interest income or interest expense associated with it, right? So it's a trade-off between that interest income and interest expense and the PE multiples from that relationship. That gig was really positive for a long time, and that gig is basically up for most companies. And so there's some that are going to be beneficial, but you're just not going to get the same amount of juice from that, which is really interesting. Now, the flip side is, like, how do you break down what a PE multiple should be for the market or for a company? And the answer is you should go back again to the foundation's evaluation. And there's a steady state multiple, which is basically 1 over the cost of equity capital. Equity capital, I don't know what it is. Pick your number, 8, 9, 8. Let's pick 8, 8.5. So your commodity multiple is 12 times, 13 times. And then there's a premium for value creation, right? So how much you should pay for a future value creation. Historically in markets, that ratio has been about 2/3 steady state and 1/3 paying for the future. So 2/3 of 12 plus 6, that'll get you to sort of high teens. That's the number, right? But a lot of it depends on what you think the prospects are, both for your steady state multiple and for the future value creation. So if the future value creation prospects become much brighter, it justifies a higher multiple, right? If interest rates go lower, of course, your steady state multiple goes up. So we try to break these things down into sort of, again, first principle components. And I guess the reason your comments got me on this track is we've had a lot of really big tailwinds with financing costs, with tax rates, with this benefit to earnings per share, that it seems like they'll be difficult to replicate, certainly market-wide, for the next 5 or 10 years.
Probably the single favorite thing you write about or do that I love walking through is these old concepts of base rates and walking through certain stocks. And it's usually like the growthy ones and what's going on, and say, hey, look, these expectations, is this possible? Has this happened in the past? If so, how many times? Is it likely? Or does this have to be like the grand slam, eyes closed, left-handed swing that really does this? And you had a old Graham and Doddsville interview. We talked about old Elon laying out a plan in 2015 to get Tesla to like 700 billion, which was like, he's crazy, right? We all know he's crazy. And then sure enough, here we are. So as you think about base rates, Elon is a bit of an outlier, but any big lessons to apply from that anecdote?
For sure. Just so we're all on the same page with the listeners as well. The idea here is that when we analyze companies bottoms up, typically what we do is what everybody does. You gather a bunch of information, you read a bunch of analyst reports, you go through 10Ks, you listen to management, your conference call transcripts, and then you build your model and you go from there, right? So you're gathering information, using your own experience to build a model. Base rates would say something like, hey, leave that aside for just a moment and just ask, we're going to put your company in as one that we'll call a reference class, like other businesses that have been in similar positions in the past. And we're going to ask, what did that reference class of companies, how did they perform, right? And let's just pick sales growth rate because that's a convenient one, right? So, you're looking at a company with a couple $1 billion of revenues that's in technology. You can say, okay, I'm going to look at every company in technology with $2 billion of revenues and just see what the distribution of growth rates look like. When you go back in time, you have large sample sizes and it's a distribution, right? So you get a sense of it. So if you see that you're projecting 30% growth rate for 5 years, and you can see that that is an extremely rare event, it encourages you perhaps to temper your enthusiasm, even if your bottoms-up model supports it. Now, I'll just mention that notwithstanding that Elon Musk did talk about how he's going to get to some very fancy market cap, the actual answer of how he got there was very different than what he laid out. I mean, he was trying to do it off a 20 times earnings multiple, and they never did anything close to that. So he got there a different way, but to his credit, he did get there. But Meb, to your point, and we wrote a very brief piece about this, but I think the one thing that I've learned is as the asset base of companies has shifted from tangible to intangible. I don't want to say any of the laws of economics have been repealed because they have not. But intangible assets tend to have characteristics somewhat distinct from tangible assets. And I'm going to mention two of them, one of them positive and one of them negative, and I'll describe how they show up in base rates. The positive one is, and it's very intuitive, is the ability to scale, right? So if you develop a drug that's successful or a hit song or software that everybody wants to own, the incremental cost of distribution is quite low. And as a consequence, you can grow really fast and very profitably. And so that's the scalability. That's the positive one. That's great. And that means companies that are intangible based companies can grow faster than what we saw in years past with more tangible based companies. That's the kind of the good news. Now, the bad news, and we want to make sure that we say both of these things in the same breath, is that intangibles often have as well obsolescence risk. So if your software today is not the latest and greatest, or your song today is not popular anymore, or your drug has been superseded by a new drug, or there's a generic now, or whatever it is, your growth rate can drop a lot faster than. So if you imagine a bell-shaped distribution, sort of, let's say, of the past, what you want to layer on when you think about intangibles is a further out right-hand side and a further out left-hand side. So a fatter bell-shaped distribution. So that's something to really bear in mind. And of course, typically we focus on the successes. So we look at the companies that are growing faster, sort of define the odds in terms of growth. We pay less attention to those companies that have gone away very fast. And we have great case studies of that, by the way. BlackBerry is an example, probably Nokia in some version is an example of that, or companies that were mentioned before. Nokia was, I think, 2/3 of the Finnish market at one point, right, as a dominant global stock. And that went away very, very fast. You think about AOL bought Time Warner for whatever, $100 billion in 2000. That business went away really fast. And so understanding this is a two-edged sword, and that is important for us as we think about base rates. And by the way, base rates, I think, are incredibly informative. I think people should be using them, but understanding that they're not distributions that are set in stone, that are immutable. They are living and breathing things that change over time, right? So they're there to instruct us, but they're not the end-all be-all.
Well, it kind of hits on your AI piece recently, which was talking about how these industries where it's this new technology that is kind of coming on the scene and looks at kind of market share for the internet search industry, brought back a lot of fond memories for me of Ask Jeeves, AOL, but also some really cool charts from companies in the automobile PC space. I mean, I do quite a bit of angel investing, and I bet it's at least 2/3, maybe it's more, of the deals that cross my plate now are AI companies that A, have bonkers valuations, and B, have no revenue. I mean, I'm sure there will be some winners, but it's kind of crazy to see. It's kind of this mad gold rush of everything getting funded, but God bless them.
When new technologies or new industries come along, this is the very specific pattern that we tend to see, is that there's a lot of experimentation, a lot of entry. We don't really know what's going on. Many of these investments should be properly thought of as options. And the market itself will eventually sort out what it likes and doesn't like, and who's going to win and who's not going to win. And then there'll be exit. And that exit could be companies going bankrupt or companies merging or whatever it is. It's certainly happening in AI. By the way, it feels, certainly when you look back at it, wasteful, because by definition, there's going to be a lot of companies that fail. But by the same token, what we know is it's a very good way to search the space to figure out what works, is basically try it out and prune what doesn't work. In venture, the majority of investments lose money. So that is par for the course. And it's just typically a relatively small percent that generate most of the returns. You mentioned Hank Bessenbinder. That work is absolutely fascinating. His work, of course, is spanning, let's call it the CRISP database history, so call it a century or so. But you see the microcosm of it in venture, right? It all happens in 5 to 10 years, basically the same pattern of payoffs in a relatively short period of time. So, and it's remarkably similar, by the way, but on a sped up timetable. So we're in that phase now where we want to figure it out. By the way, other industry, electric vehicles, same thing. We're in that phase of experimentation. We don't know exactly what's going to work. We're going to see lots of entry. and we're going to see lots of exit. It could feel disconcerting from a micro point of view. If you own any of these companies and they die, or you work for a company and it dies, that's not fun. But from a macro point of view, this is typically how capitalism works, right? You try stuff out and you prune the stuff that doesn't work. So I can see why it feels wasteful, but it's actually what happens every time.
You mentioned earlier, which resonates very much with me, that you wrote a piece kind of offhand and it was like hugely popular. What's something that you've written where you're like, oh, baby, like this is brilliant. People are just going to clamor for this one. I love this paper idea. And then you publish it and it's like crickets, because that's like most of my papers. But anything stand out where you're like really excited about an idea and then there's the world doesn't care?
I can 100% relate to this. The one that comes to mind immediately, it was an execution of something that is somebody else's idea, is we wrote a paper about corporate life cycle. Here's the thing that was fascinating about it is that, we have a lot of good return on capital data in our little database. And a corporate life cycle is, people typically understand what it looks like. It's sort of this arch, right? And by the way, I wrote a book about luck and skill. There's also an arc of luck and skill, like your skill arc. Okay, so what happens is you're a young company, you're investing a lot, you're not super profitable, right? You're kind of getting going, so your returns are not great. And then you sort of get to middle age and you're profitable and you're clicking, the market's developed and so forth. And then you get older, competition, in essence, and bureaucracy, and also sort of this curve of returns. So I'm like, awesome, let's run it for companies since they've been public. By the way, a lot of this was actually inspired by Best & Biner. So we run it, and the pattern we get based on age from IPO has nothing to do with that picture at all. In fact, it's almost the opposite of it. So I was like, wait a second, what's going on? So I remember there's a lovely paper from 2011 by Victoria Dickinson, a professor of accounting at University of Mississippi, where she said, you know what, we should be not thinking about life cycle in terms of age. We should be thinking about life cycle in terms of how companies invest. And so she did something very clever. She went to the statement of cash flows, because there's cash flow from operations, cash flow from investing, cash flow from financing. They're positive or negative. So she went through the various combinations, 2 to the third, so 8 combinations, and put them slotted into the life cycle work by Steve Klepper and Michael Gore, so the very famous life cycle. So she did something really neat with financial statements, put it into this Klepper-Gore framework, which is also very well known academically, and created this. So we're like, awesome. So we'll pick up on that. And then we made a couple of additional adjustments. We moved stock-based compensation. We take into consideration intangibles. We removed the effect of excess cash and marketable securities and investing. So we made some tweaks to it. And then we ran it through the model, and it was beautiful. So we were able to recover that arc. The ages worked out well. The return on capital pattern worked out beautifully. So the whole thing was really interesting. And then the 2 other things we did that were really cool is we did a transition matrix to say, if you start off as a young company or a mature company, like what's probably you'll become a growth company, whatever it is. And then once we knew the transitions, we then looked at the total shareholder returns and said, if you transition from this phase to the next phase. And by the way, so the point of this report is you can go forward and backwards, right? If you go to maturity, you can actually go back to growth if you find a new opportunity and it shows up in your financial statements, right? Of course, because you're investing a lot. So you can go forward and backward. It's not just like all of us are just going to age. We're only going one direction. But companies can go back and forth, which makes sense and feels right? Companies reinvent themselves, or they have a new line of business that sort of takes over. And then we have a fun thing at the end. It's just sort of eye candy, but we just look at a series of about a dozen companies and just show how they evolve, their life cycle spots changed over time. And it's really fun. It's cool to see like how companies bounce around and why they bounce around and so forth. So I would say the life cycle thing was one that, and I think there's much more work to be done on that. It's really interesting. And I think we've scratched the surface on that. And by the way, that for all the quants that are listening out there, there's probably an interesting quant angle on this, because what we found replicated what Dickinson found, but some of these results were actually quite strong. And I'm sure if you scaled it up, it would not be as profound, but even if it's a decent sized signal, it might be fun to play around with.
Certainly brings to mind Amazon, AWS, or Microsoft Cloud.
100%. That's perfectly a perfect example of how something can come along to become the mainstay unanticipated, right? Yeah.
We're going to do a few more quick questions because we only got you for a little bit and this time has flied by. My favorite question of this cohort has been, what does Michael believe that if he goes and sits down at a table with all his buds and says this statement, so investing pros, what is a belief you hold that 75% of your peers would disagree with or shake their head and said, Michael, I can't believe you just said that. You're crazy. Anything come to mind?
I'll tell you one that I think is an area that I'm doing a lot of work and reading a lot about is the question is, how much has indexing or rules-based investing affected market efficiency? And I think that there's a common narrative, some of it which is demonstrably wrong, but a common narrative that somehow indexing or rules-based investing has undermined market efficiency. It's devilishly difficult to demonstrate that. I think there are mechanisms by which that might be true, but I think that most of the stuff people talk about is not right at all. The basic idea, of course, is if you buy an index fund, people go, it's going to drive up the large cap stock. I mean, obviously, you're buying every stock in the proportion of its market weighting today. So you're not changing anything, right? That basic argument doesn't make any sense. So that's an area that I'm really interested in. And I think there have been some papers that have tried to do this, but this idea that we're never going to go back to 100% active. We cannot go to 100% indexing by definition, obviously, right? Because there has to be somebody to ingest and reflect that information in prices. How do we think about what that equilibrium looks like and how far are we from it or how close are we to it? That to me is a super interesting topic.
The place I get stuck there is the numerous amount of funds that, so on aggregate, you get in the market cap weight, but all the funds out there that are just closet indexers, they call themselves active, but then they're essentially the S&P. And that's not that infrequent. And particularly when you smush them together, these half may be closet indexers towards growth, and these half are closet indexers to value. But when you put the closet index together, you get the S&P. And so then it's like, to me, it gets muddled, but I'm looking forward to reading it when you write it up. Too much work for me. We got a few more Darwin quotes. My favorite Darwin quote so far that I really resonate with is, he says, "I've tried lately to read Shakespeare and found it so intolerably dull that it nauseated me. I feel like this is a big non-consensus view I have. Everyone loves Shakespeare. I struggle with that more than any writer I think I've ever read." But here's the one for the next question. And I ask you the question, then read the quote so you have time to think about it. Because you're someone that reads a lot. So I want to hear kind of what you're reading these days, anything that's on the curriculum for the kids or any music you listen to. But old Charles said, if I had to live my life again, it would be make it a rule to read some poetry, listen to some music, see some painting or drawing at least once a week, for perhaps the part of my brain now atrophied would then have been kept alive through life. The loss of these tastes is a loss of happiness. So what's Michael reading? Anything good these days?
By the way, on that Shakespeare Darwin thing, one of the things I just read recently was his autobiography. So I don't know where you're getting these from or if you're just Googling them, but I think he said something like when he was younger, he was actually pretty into it. And then when he came back to it when he was older, he got bored by it. So it was actually an interesting contrast. So I've read a bunch of books this year. I'll mention probably a bunch of them that I in particular liked. The one that's a little out there is there's a book by a guy named Max Bennett called A Brief History of Intelligence. And it sounds like it's about intelligence, but it's actually more, if you're a fan of neuroscience and evolution and artificial intelligence, you'll really find this book fascinating. So he goes back starting 500 million years ago with nematodes and goes through like essentially the breakthroughs that animals have had to lead to us humans today. So these 5 breakthroughs, and it's really well researched. It's very interesting. By the way, if I could take a course, I don't know if he would be willing to teach it, but if I could take a course in this, I think it would be absolutely awesome. Love that. Just being a citizen of the world. I think Jonathan Haidt's new book, The Anxious Generation, especially for people with younger kids, is a really big deal. So the impact of technology and how it's affected, especially our younger people. I have 5 kids. They're much older now, but even the tail end of my younger kids, I think got sort of caught a little bit of this exposure. I think COVID was horribly timed for a lot of people. So that's, I think, a really interesting one.
You mentioned this and also Nokia earlier. It's like, I want to go back to a Nokia fund, but at least you're starting to see the dominoes, I think, are moving in the right way, where at least a lot of the schools are starting to ban. I saw Virginia did it, where they say can't have these funds at school.
It's a collective action problem. So the issue is that people have to do it together, but hopefully will. My favorite book on complexity economics, perhaps ever, is the new book by Doan Farmer called Making Sense of Chaos. Doan Farmer was part of the original Chaos Cabal, Santa Fe Institute. He's now at Oxford. He's a super smart guy, ran a money management firm, but a big advocate for agent-based modeling. And I think if you read that book, you get a real sense of what complexity economics brings to the table relative to sort of traditional economics. I got the book in the UK, and I think it's coming out in the US this summer or the fall. So I don't know if it's available widely in the United States yet, but I thought that one's terrific. The other one I really liked was a book by Sal Khan called Brave New Words. And it's about education. And there's a lot of questions about what artificial intelligence will or will not be able to do for us. I think he makes a pretty compelling case. I think he's been working on it pretty compelling case that AI may really be an effective tutor for our young people and for our older people too, but for certainly our younger people. That seems like a really exciting application, right? And especially for disciplines like mathematics or even parts of science, to have an AI tutor be there with you, patient, it's Socratic. So it's not telling you answers, it's nudging you in the right direction. I think that's a pretty cool thing as well. So those are just a couple.
You mentioned Santa Fe. What's a guy got to do to get an invite to this place? Is it hidden in a bunker in New Mexico? Is it still going? And what's the...
Oh, yeah, absolutely still going. Never been better. And this year is actually the 40th anniversary. To bring everybody on the same page, Santa Fe Institute was founded in Santa Fe, New Mexico, 40 years ago. The founding fathers believed that academia had become too siloed and that there was a lot of interesting stuff at the intersection of disciplines. So it's a non-degree conferring institute, but studies complex evolving systems and remarkable sets of people, really cool, fun science. And I think for me, obviously, they're doing a lot of, in quotes, science work, but there's a ton of stuff that's relevant for us. I think understanding markets as complex systems is step number one. I mentioned Doan Farmer's book and sort of the really exciting potential applications in the world of economics to better understand our world around us. I first learned about like really powerful ideas like increasing returns from the Santa Fe Institute. There are many different flavors of increasing returns, but the idea of network effects, and I learned from there. Come visit. If you're in Santa Fe, just come by. It's a beautiful place, warm, friendly, and intellectually awesome people.
You were officially batting 1,000 on coming on the show, and small cap value absolutely going on a face ripper. So anytime we need to conjure some market returns and the market concentration reversal, you're going to be the bat signal on who we call from Connecticut to get the spark, the rally. Michael, this has been a blast. Where's the best place to find you for everybody? Where do they go?
Thanks, Mab. Fun talking. MichaelMauboussin.com. And that's going to be sort of the books and a bunch of readings. And then my X, formerly known as Twitter handle, at MJ Mauboussin. I'm not on that much, but from time to time, I'll drop a couple things.
Michael, thanks so much for joining us today.
Thank you. It was really fun.
Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.